How many of you have been going through the home buying process and were surprised by the closing cost? Maybe they started at an initial number of $4,000 and then suddenly it changed to $6,000. And then when you finally got the loan estimate, it was $10,000. What is going on? In today's video, we're going to go over exactly what tricks and hidden costs you need to look out for and how to read the loan estimate. So stay tuned. All right, today we're going to go over the loan estimate. What is it and what you should be looking out for? And so I can't tell you how many times myself as a lender I've received a loan estimate, but it's not actually a loan estimate from a client. Maybe they've already been talking to a lender or a couple of lenders and they want to get a quote from me and they send over the loan estimate and it's not a loan estimate, okay? The loan estimate is an official form, and here in a few minutes I'm going to share my screen and I'm going to show you a loan estimate. We're going to walk through it. If a loan officer emails you a quote or text or a cost worksheet, that's usually the biggest ones that I see is a cost worksheet. These are non-binding documents. They're not regulated by the CFPB. So I don't want to say they don't mean anything, but they're not regulated. A loan estimate is a regulated document. Once a loan officer puts costs in there, they cannot change. They can't all of a sudden just like increase them or increase the interest rate and say, gotcha. No, it doesn't happen. So what we're going to do today is go over the loan estimate and what to watch out for. Okay, so let me switch up and share my screen. All right, here is an actual loan estimate form. It's usually about 3 to 4 pages. And how do you know it's a loan estimate? Well, it says it right here, loan estimate, okay? This is what a loan officer will disclose to you after you're either doing a refinance or you're doing a purchase and you're under contract on a property and you've gone through the application process and they've submitted your loan and they've registered it with the lender and they've disclosed the loan estimate. So I've redacted the personal information on this, but this is an actual loan estimate. And so at the very top right here, it's got the lender's information. It says loan estimate. It shows the sales price. So in this case, you can see the loan amount is less than the sales price because in this case, the borrower was putting down $55,000. And then right here, here's the terms. It's a 30-year fixed. This one was a VA loan. This is the big kicker. So the step number 1 right here is what I want you to look out for. Is the rate locked? Yes or no? Yes, right here, it's checked. Yes, this rate is locked. So many times I've had clients send me, hey, in this case, I'm locked in at 4.902%, and I look and it says rate locked no, meaning it's floating. When you hear a loan officer say they're floating the rate, that means the rate is not locked. They've sent you a disclosure based on what the cost and fees and everything are based on that rate, but it is actually not locked in. It could go up, it could go down. You're truly at the mercy of the market. So this one shows that it is locked. It shows the loan amount, the interest rate, and then the monthly principal and interest. Now, this is not the total payment. So I've seen people get caught up here. A true monthly payment has 4 components, 5 if it's a conventional. So you have principal, you have interest, you have property taxes, you have homeowners insurance, and if a conventional loan or FHA loan, like you might have mortgage insurance if you depending on your down payment, and then technically you could have an HOA, which is not going to be collected in this escrow, but is still coming out of your pocket if you have a monthly HOA fees. So this one right here is showing the estimated escrow of property taxes and insurance. This is a Texas property in this example, so Texas has really high property taxes. And so that is the total estimated monthly payment. And again, what you want to look out for is, hey, can this increase after closing? Can this 4.9 increase? No. Can this loan amount increase? No. Like, these things are locked in. Is there prepayment penalties? If I was to pay off the loan early? No. Is it going to balloon? Balloon is where a drastic change in interest rate after a certain amount of time. No, it's not going to balloon on you. Okay, so this first page is kind of an overarching, encompassing snapshot. The second page of the loan estimate is the meat and potatoes of what's going on, okay? So let's go down and check out what is exactly involved in these closing costs. Here is the second page, and I want to be very clear. A lender has only control over one block on this loan estimate, and we call them Section A origination charges. And as you can see right here, there's nothing. There's no charges in Section A. In an ideal scenario, this is what you want. This is what I control as the lender. So you'll see different items in here. You'll see them sometimes called an application fee, a processing fee, an underwriting fee, a lender fee. They're all kind of the same thing. They all get rolled up into origination charges. This is where, if you're comparing lenders, if you're comparing lender A versus lender B, and they're at the same interest rate, Section A is the tail of the tape. That shows you how are they getting this rate. I've seen it before where somebody sends a very attractive loan estimate. Oh my gosh, I got 2.25% or 3.25%. Last year, those were kind of common interest rates, and they're jazzed about it because that's a low interest rate. But they don't realize they come in here in Section A and they're not seeing that there's 2 discount points or 3 discount points and all these fees that are being charged to get that rate. So this is where you have to pay attention on Section A and see what's going on, because that's what the lender controls. All these other fees and prepaid items, that's a common misconception, is people think that the lender controls them. We don't. These are true third-party fees. So appraisal, title insurance, transfer taxes, homeowners insurance, we don't control that as the lender. And so it's going to be up to whatever third party that you're using to go out there and get quotes and estimates and everything. So in this case, the total loan cost is $63.83. You know, in this VA loan, this is another little side note. In a VA loan, usually the borrowers are subject to a funding fee. There's scenarios where they're not, where they're exempt from the funding fee. And so as you can see right here, normally there would be a VA funding fee, but this borrower had a VA disability compensation, which is, you know, a 10% rating or higher. So he is exempt. So there is no VA funding fee right here. But normally it'd be in Section Bravo right here. Section Charlie, this is generally where pest inspections, surveys, title insurance premiums, settlement fees, these are generally where the title fees go. You have to have title insurance when you're doing a mortgage. It is required to have a lender's title premium on there. And so this is where that goes. And then over here in Section F and G, so let's talk about prepaids. So this was just an estimate. At this point, I didn't have his actual homeowner's quote, but I was estimating $3,000. Here in Texas, our property taxes and our property insurance are pretty high because Texas has hailstorms and tornadoes and hurricanes from the Gulf. So there's a lot of claims that drive insurance premiums up. So you have to pay a full year of homeowner's insurance up front. So it is a prepaid. You got to pay for it. I mean, think about it. If you were a lender and you were giving somebody a ton of money, hundreds and hundreds of thousands of dollars, you would want to make sure on day one, in case there was some drastic event like a fire or tornado or something, that the house was insured. It's because you have a lot of money out there that's tied up in the house. And so that's why lenders require homeowners insurance be prepaid up front. You got to pay for a full year up front. And so that's where you see that. Prepaid interest is based on when the closing date happens on the month. And then the initial escrow payment, again, this one was happening towards the tail end in Texas of the year. Property taxes in Texas, this is state dependent, but in Texas, they are collected one time a year, and it's at the end of the year. So we were having to collect 11 months worth of property taxes because the closing was happening towards the end of the year. And then in the escrow account, you have to pre-fund some of the escrow account as well, because there's going to be a delay from when your first payment is after closing. So let's take an example. Let's say this was closing in October. You're going to skip November's payment. Your first payment would not be until December. So you need to start, but the escrow is going, right? Because 12 months from now, you're going to need to pay your homeowner's premium out of that escrow account. So we need to start pre-funding it. And if there are any lender credits, they show up down here in Section J. So this one, there was a small lender credit of $24. And then right here, he had made an earnest money deposit ahead of time. He had already prepaid $7,200 as an earnest money deposit. So we're going to credit that back to him as part of his closing costs. And here is that estimated cash to close, $71,000. Of course, this accounts for the $55,000 down payment. So that is what you need to look out for when you're looking on a loan estimate. Again, I can't emphasize this enough. If you're going to take anything from this video, when you're getting a loan estimate, make sure it's an actual loan estimate, so it's in this form. It can't be a cost worksheet or an estimated fee worksheet or anything that's like in an Excel file that I've seen people send over. Make sure the interest rate is locked, for one, and then two, check out the fees that are going on in section A. Most lenders charge anywhere, from around $1,200 to $1,800 in origination fees. Okay, so that can really change your closing costs. So be sure to be looking for that. If you have any questions, please reach out. Thanks.